You know, the way that Singaporeans talk about the MRT, you could be forgiven for thinking that the company that operates it is in a whole lot of trouble. But the annual report, titled Twin Tracks to Performance and Growth, dispels that. For starters, this document talks about the government's plan to increase rail services by 2030. For example, building 5 lines costing $60 billion to ensure that 8 out of 10 Singaporeans have an MRT within 10 minutes walk. And chances are you won't get wet or too steamy because there's also 200 kilometres worth of walkways, sheltered walkways that are going to be built. And the rail network itself, as part of that those additional lines, will double in size to about 360 kilometres. So there is actually a lot of good news in this annual report as well, and it extends to some of the financials as well, as you'll discover in just a few moments. If you still have doubts about SMRT's performance, you might like to turn straight away to page 43 of the annual report, where you'll see this funky photo. I think this was taken at Jurong East Interchange. But the table below is actually the interesting part, because it talks about the punctuality and reliability of the various lines. And what you'll see is that all of the scores are actually very good. Some of the scores are a little bit soft, but that's because trains have been going slower in order for the engineers to change the sleepers. As you'll be aware, the trains have been starting later on certain days so that the engineers have more time to replace the wooden sleepers with concrete ones, and that's also brought about slower trains, and that's why punctuality was affected. Not because there's anything fundamentally wrong, but a deliberate slowdown. Right, so once again, there's actually quite a bit of good news in this, and if you go to page 8 and 9, you'll see the 5-year history of the financials. And again, up and away as far as some of these charts are concerned. Look at revenue. Upward trend intact, hasn't really changed despite all of the troubles that they had, including the July 7 power outage last year and the various other breakdowns that we've heard about in recent years. Revenue now at 1.3 billion. Cash and equivalents, you can see the spike in previous years from the capital raising, but the $330 million in operating cash flow was a very strong number, and in fact they had free cash flow, positive free cash flow for the first time in 3 years, $75 million. The net asset value at 60 cents is the best in at least 5 years, and the dividend at 4 cents for the year entirely is the best since 2012. So once again, quite a bit of good news in the annual report as well. But obviously not everything's rosy, and we start to see that in the profit after tax and minority interests, the PATMI number. Sure enough, that number was up 20% at just under $110 million compared to the year before. But that includes a $19 million tax credit for overpaid property tax. If you take that out, it would actually have fallen. Profit, in fact, would have fallen. When we look at the rail business in particular, we can see how that plays out. You can see the very long bars on the top are the 2016 and 2015 revenue numbers, and the two very short bars at the bottom are the operating profit numbers. So much revenue for so little gain, I guess, is the way that you can look at that. Revenue improved 4% due to higher ridership and higher average fares. But once again, that $19 million tax credit on a group basis, 17 million of that belongs to the rail business. So once again, without that tax credit, it would have actually been an operating loss of almost $10 million. So, with the lines, half the lines being more than 25 years old, you would expect a lot of money being spent on maintenance and repair, and that's really what commuters are asking for anyway, for the service to be upgraded to make sure that we don't have the sort of outages that we had in the past. Something else that's on the horizon is some of the fare cannibalization, but I'll talk a little bit more about that in a moment. When we look at the non-rail revenue overall, you can find this on pages 2 and 3. What's interesting to note is that the non-rail revenue accounts for 47%, so almost half of total revenue, up from 45% 5 years ago. So once again, you can see how that twin tracks is very important to them. This is the chart here, which shows where the money is being spent and why we've seen, despite that long revenue chart that we saw earlier, here it is again, this time expressed vertically. And then you can see in this waterfall fashion where all the costs were. Staff costs, depreciation, energy, so-called other costs, and then we had repairs and maintenance costs. All of those costs are up except energy costs, which actually fell. Mixed blessing, as I'll explain. Page 33, you have this outlook statement, which shows you in essence that the group is expected to incur higher operating expenses still for the coming year, 2017. But fare revenue at the same time will actually be going down by almost 2% because of the fare reduction, possibly to do with the lower energy costs and the cannibalization of the Downtown 2 operations. So things weren't too great in 2016. The outlook continues to be tough. I guess that's the overarching theme. And as we read the annual report, we'll want to see whether there's more evidence to support that, or in fact, we get some news to detract from that trend. Let's go through to see how it turns out. Firstly, let's go to page 14 and 15, where the Chief Executive, Desmond Quek, gives his commentary. He says that without a commensurate fare level to be able to meet all those operating expenses, all of those repair and maintenance expenses, all the extra staff they've brought on board to help with that, this will not be sustainable for the rail business under the current license terms and conditions. Fortunately, as we'll read on page 12 and 13, where the chairman, Ko Yong-Guan, says that management anticipates more risks on the horizon and is directing its focus on macro-level risks. But he goes on to say that the sustainability of our rail business will continue to be challenging under the current financing framework. Fortunately, we've been in discussion with the authorities on the transition to the new rail financing framework, NRFF. I looked through the annual report to see when the NRFF was going to kick in. I couldn't see any updates on likely start dates, but at least it certainly sounds like in the year ahead this is something that they're working towards. It's been under discussion for quite a while. And once they do transition to that NRFF, what that will mean in essence is that SMRT can focus on operating the trains and not have to take care of the asset-heavy infrastructure that goes with the rail lines. Meantime, just a little PS to that. While they're focusing on that transition, while they're trying to make sure that the rail services continue to be safe, that the reliability continues to improve, that the repairs and maintenance and the upgrading of the lines continue, the board upgrade, that is the board renewal, is on hold. So there are two independent directors on the board who've been there for more than 9 years. You'll read more about that in the annual report. They vouch for their independence, but don't expect any board changes if you've been looking for them. Right, so overall, the trend that we kind of see in the rail business is it's been tough, things have been improving, but don't expect brilliant times up ahead just yet. Let's turn our attention to the bus business. This chart you'll find again on pages 2 and 3. They now have 1,400 buses carrying about 1 million passengers a day on 106 routes. Revenue improved and they swung to an operating profit. It's not a very fat line, as you can see. It's still a very thin one. But that's the first operating profit in 7 years. They are investing more in elderly-friendly and greener vehicles, and they're finalizing the government contracting model, which will see them operate their existing routes under a 5-year model starting in September. Let's look at taxis, and once again, you'd expect taxis to be under pressure given the popularity of Uber and Grab Taxi and so on. But in actual fact, SMRT is working with Grab Taxi, and it's launched its own private limousine and private car hire business called Stride. These so-called chauffeured and limousine services. The taxi business still seemingly going quite well, and you can see the operating profit number is a lot better than it is in the core train services. The so-called other services, which is Bus Plus and automotive, revenue and operating profit there improved. And looking at the next page here, pages 4 and 5, this is one of my favorite pages because what it really shows is just how much advertising and rental, so-called commercial services, are benefiting for SMRT. Check out these bar charts. I've kind of put them together here in this graphic. Isn't that amazing? The revenue is actually not that much compared to the rail business. It's a fraction. But the profitability of that part of the business is just tremendous. Engineering services, lower revenue, but they narrowed their operating loss. You could say that it's almost at break even. So lots in this annual report for you to digest, and once again, go in with an open mind, because and don't listen to what your friends say about MRT. Things are improving, some tough years ahead, but obviously they're working in a variety of ways, and some of which I haven't even talked about yet, such as their expansion of their international businesses. In other words, helping other countries, other cities abroad improve their train services like they've done for Abu Dhabi since 2010. All of that you'll find in the annual report, and I warmly recommend that you read it before you go to the Raffles City Convention Centre on Tuesday, the 5th of July at 2:30 p.m. for the annual general meeting.